Hello, everyone. Today is Friday, the 30th of September, 2011. This is Brian Shannon from Alpha Trends. The market closed here for the day, the week, the month, the quarter, and it was pretty ugly looking here. Let's take a look at the table here, just for a moment. The SPY today was down 2.5%. For the week, it only lost 0.75%, or 1/3 of a percent rather, but it was a brutal month, down 7.5%. The only positive weekly change was in the financials and in the Dow, but as we'll see in a moment, things are looking pretty ugly here, and we are down near the lows for the year on many of these. In fact, a friend of mine, Andrew Horowitz, who has a great website and should follow him on Twitter. He had sent me this, which is commodities futures returns, and you can see here just for the month. This is as of today. I guess at the end of the day today, copper was down almost 25%, silver 28%. I mean, some of these commodity moves have just been massive here recently. So a lot of broad selling in general, and the U.S. dollar has been in an uptrend here. It's at an interesting place, the U.S. dollar, because this is the U.S. dollar index. That is, this is basically it's trying to work through this prior level of support which it held in 2009 and 2010, and it's too early to say that it's holding there or that it will be able to continue to follow through on the upside. But when you look at a bullish chart, this is what it should look like. The early pullbacks are finding support at the rising 10-day moving average. The pullbacks are coming on lighter volume relative to the advance. So the U.S. dollar is moving higher, commodities are down, and U.S. equities are in a downtrend, obviously, as well. This S&P 500, we've seen the lower highs underneath the declining 50-day moving average, and although the market was only down slightly for the week in terms of percentage, it's right back down again towards the low end of the range. The more times that support is tested, the more likely that level is to hold up any further, and more likely it is that it will actually fail, is what I'm trying to say. As it's typical that when the primary trend, when you look to the bigger picture and you look at the direction of the 50-day moving average, which are lower in the bigger picture, the weekly time frame is in a downtrend, that these sideways consolidations are generally going to resolve themselves in the direction of the primary trend. You could maybe even start to make a case that this is making a descending triangle. The point is the sellers are getting more aggressive as they don't wait for a bounce to 123.5 before they take control. Instead, they took control last time at 121.5, and this time up at 119.5 or so. So the sellers are getting more aggressive price wise. They're not waiting for those bounces, and now we're going to start to see probably some more frequent tests of this support, and it's likely that support it seems inevitable and almost imminent that support will give way. The 30-minute time frame, or actually let's look at the 10-minute time frame. We've been in this little downtrend here. We had the gap higher on Tuesday. We've been working that off, obviously, and just a steady pattern of lower highs and lower lows, and now we're back below this level, the 114, which had been some resistance. Which found support, of course, on Monday, and that's where we had that rally. But we're back below that, and there just seems to be a large amount of frustration in this market. Bear markets are more difficult to trade. I know some people do real well in them, but you look at today's action, and it was an obviously bearish day, but it was very choppy in here, and getting that 2.5% down move. Of course, you had to take some overnight risk to get the entire 2.5%, but it spent a large amount of time really doing not much of anything here, but did find resistance at the 2-day volume weighted average price, which is always interesting to keep an eye on. And here late in the day, they tried to push it higher here at the VWAP, up to the VWAP. It failed, and we had that bigger selling come in. So for next week, obviously, all eyes are going to be on this basically 112 area for the SPY, and we've been looking at a couple things here on this weekly chart. Let me just kind of tighten this up a little bit so we can see it more clearly. What we'll do is we'll take the volume weighted average price, which we looked at yesterday as well, but we'll take that volume weighted average price from the March 2009 lows, and you can see that right here we've got it at basically 110.88. So that's approximately the average price that the SPY has traded at during this entire, well, from this time here over. So what we can also look at, and what we've been doing, is taking a look at this Fibonacci, which is the retracement levels. We've seen so far that on this from this move up from 65 or whatever it was, 66 up to 138, that we've found support so far right around this 38.2% retracement level. The next logical level for Fibonacci for a downside would be at that 50% retracement right down here at 102. Well, you can't just trade on that, I don't think. But if you look at it and say, this has been an important level before as far as support. So it seems to take some significance on as far as prior support as well that has the potential to become a downside target once again. So I think it's crazy to look into this and read anything bullishly. I know some people are thinking, well, we're getting down to the bottom end of the channel and I'm going to play the channel. Well, that channel is definitely intact. You could say that we're at the low end of it, but the problem is, again, we have these lower highs indicating a more aggressive source of supply coming into this market, and eventually the people who are buying down here are just going to kind of give up on that, move to the sidelines, and wait for the prices to come to them at lower levels, or they're just going to say, hey, listen, let's give up on this support in here. It looks like a breakdown is likely, and they're going to add their own supply to this market. Either way, you just can't look at it bullishly. So those are the key levels next week. Now, if we get back above maybe the 116 level and hold above there, then that'll be something interesting. But it feels doomed here, and maybe that's a good thing. A lot of times it looks its worst right before a turn comes, but it just doesn't feel like it right now. The Nasdaq, of course, we've looked at this trend line and the fact that it hasn't been perfect resistance, but it's kind of finding resistance in there. And we do have a lower high on the weekly chart in the Nasdaq. We take a look in here, we have seen a much better performance of the Nasdaq. We haven't even retraced, not even close to the 38.2% retracement. But if we got down there at the same time that the SPY got down to its 102 level, it would be very similar. And we could take a look in here also. We should do this for the SPY as well. I think I did it earlier in the week. But if you take a look at, let's just call this high 60, and down here this is about 50. So that's 10 points. If we take this high right here from 57, that would give us a downward target of 47. So what we're talking about is the measured move, that the height of this move would equal to the next move lower. Now let's put those Fibonacci levels back on and take a look at where that 38.2% retracement lines up, and it's pretty much dead on with that measured move. So it becomes a more likely level because more people are focused on it for different reasons. A group might be looking at it based on Fibonacci. Another group might be looking at that 47 level as a measured move target. Either way, it's still a valid way to look at the market as far as where is the potential downside. Now the Nasdaq got down to what's been an important level here for the last couple of weeks, and that is this 52.5 area. If we take a look at the let's take a look at the 65-minute time frame, we had seen that this up channel has been broken. We had this pattern of higher highs. Now we have a lower high, and really we're right at the support. So maybe early next week we somehow get a bounce, maybe even up towards that 5-day moving average, and from there I think it would make a lot of sense to then look for another one of these little types of bumps to occur over here, and then look for the market to roll over. Again, it's like the rest of the market. It seems inevitable that it should decline. We've had a pretty good little sell-off from 56 down to this 52.5 level, but there's no guarantee we're going to get that bounce first. So I wouldn't be looking for the bounce. I would be looking for downside opportunity in this market. The Russell 2000, as we know, has been really the weakest, and as far as a broad market goes, this is 2,000 stocks, and small to mid caps, and these guys, they led on the way up, and now they're leading really kind of on the way down. If we take a look at, let's take a look at two things. We'll look at the volume weighted average price since the March lows, and we'll see that we're basically flirting with that level and right below it. And we're also, if we take a look at the Fibonacci, as far as these retracements go, we've exceeded the 38.2. We're kind of in that area, and 60 just looks about right. That's what we've been saying this week, and that was a 10% move as we were at 66. Now it's only I guess about a 7% move, but the Russell is really vulnerable here, and it's a pattern of lower highs and lower lows that we see in here. I would say that if we somehow get back above 66 and a half next week, that maybe it's going to be able to pull another rabbit out of the hat here. But when you break that big level of support, and right in here, we're in this band really of that is getting tested more frequently. We have the lower highs. It just feels inevitable that we'll break and head down towards 60. Semiconductors were down 3% today. We know that they had given up that 29.5 to 30 level and been flirting with it. Well, today we broke the next level that was supposed to hold as support. So maybe early next week we get a rally up towards I would think maybe 29.5, 30 at a maximum. But I would be looking at that area as that's the place where you want to look for evidence that it's beginning to break down again on the shorter term time frames, and look for your short entries in the semiconductors, because a test of at least these lows at 27 and a half ish seem very likely for the semiconductors, and perhaps down even towards the 25 level would be something that we could see happening there. The financials were on a weekly chart, so let's take a look at those, and let's just take a look for the heck of it. I mean, we're going to be well below it, I would think. But the volume weighted average price since the March lows is actually what had been this prior bigger level of support, which had held as resistance here just about 5 weeks ago. Well, down to the daily time frame, we know that 12 to the range had been basically 12 to 13 and a half. We broke the downside end of that range. From that failed breakdown came this fast move higher, but only up to a declining 20-day moving average. We've got a declining 10 below the declining 20, below the declining 50-day moving average, and it just seems inevitable in here as well that we're going to head down at least towards this level at about $10.80. If we look at Fibonacci off of this, we can see that we're right now at a 50% retracement. So let me just clear up these other lines to just so that we can see just the Fibonacci by itself here. From the 2009 lows to the recent highs, we're right now at a 50% retracement. A 61.8 will get us down to 1025-ish. I think this is really probably the bigger more obvious level where we might test would be that $10.80 level, but that's the way it's looking right now. Something I had mentioned, I don't know if you'd heard it on Thursday, was just this that this Apple might be starting to be something that weighs on people and their confidence, as well as they get more tablet competition from maybe a good competitor for once, and that could begin to weigh on the psychology of the holders in there. Apple has been holding for the most part this rising 50-day moving average, and it's not broken yet. But I would be concerned about it, I suppose, if I was a Apple shareholder who was looking for a place to lock in profits or that. But I'm speaking as a trader, as a catalyst for the rest of the market. If you've been holding Apple for years, then you do a much better job than holding me. So please don't listen to me on that. Anyways, hope everyone has a good weekend, and I'll talk to you next week. Thank you.